Good afternoon and welcome back to the Commercial Wealth channel. I am your host, Troy Lerche, bringing you this weekend wealth. I'm going to do a little differently today. As you can see, I have our printed version of the materials we send out every week that I base a lot of my dialogue on. This is for the week ending October 15th, 2021. And then we're going to switch over to the health savings account information that I promised. All right, so I'm going to scroll down a little bit here to show you the CAPE indicator. CAPE indicator is now up to 38.08 from the prior week's 37.93. Also show you a little bit about our, these are the four indicators that are all green right now, even though we are on high alert for a potential, pullback in the near future. For the markets last week, the U.S. stock market continued to build on previous week's gains. We had large caps gaining 1.8, while mid caps, S&P 400, and the small caps finished up 2.2 and 1.5 respectively. Commodities also participated in the uptrend this week. We had West Texas Intermediate crude going higher by 3% to 81.73 per barrel, and which was the 8th consecutive week of gains. And then copper, the industrial metal copper, actually surged 10.6% last week. We have a lot of economic data out in our report. Make sure you check that out. And again, if you don't want to make sure, or if you want to make sure you don't miss any content, please hit the like and subscribe button. We have a little bit about the Fed. According to the minutes of the Federal Reserve September 21st, 22nd meeting, they just discussed the plan to begin slowing down the emergency support of the economy in either mid-November or December. So that's another thing that I've had a lot of conversations with my clients about and how that's going to affect the stock market. And finally, one piece that a lot of people are talking about is the cost of food, gas, and everything else. Pretty much, I've talked to everybody. Everybody's feeling it, from cars unavailable to unavailable items at the grocery stores. Even Walmart's out of some things. But people are starting to really think that the inflation concerns are not transitory, as the Federal Reserve continues to assert. According to a New York Fed survey of consumer expectations, the inflation expectations for 3 years from now jumped to 4.2%, which is the highest in the survey data set, and 5.3% for just 1 year out. But expectations for income growth are way behind that, at just 2.9%. So if these expectations come true, Americans will be forced into a lower standard of living as expenses will outrun income. And the chart below is from wolfstreet.com. You have the red line as the consumer expectations of inflation up here, closer to between 5 and 5.5. And then we have the earnings growth in green, which is right here just below 3%. Now I'm going to switch screens over to my HSA presentation. And this is about health savings account, or HSAs, how to get the most from your HSA account. Again, these are just brief little tidbits about what they do and some one particular strategy called SHOEBOXing that I'll talk about. And if you have any questions, please reach out to your personal wealth advisor or the Camarda main line, and we'll be happy to help answer your specific question. So a couple things you need to know about an HSA and how they're triple tax advantaged is you get to put money in pre-tax. You have pre-tax contributions either through payroll, or if your employer puts money in, it's not taxable to you. So that's pre-tax contributions. And then what a lot of people think is that you just leave the money there for your medical expenses or you use it. Well, actually, HSAs have an investment component under most plan providers. So you could keep some of it. They may require you to keep like $1,000 in cash, but then the other amount can be invested. And all the growth on those assets are tax-free while they stay in the plan, like your 401k and other qualified accounts. And then actually, as you pull the money out, you get, if you use it for qualified medical expenses, it's actually tax-free on the way out. Whereas there's no other account like that, right? Your IRA, you put money in pre-tax, but when you pull it out, it's taxable. Your Roth account, you put money in after tax, and when you pull it out, it's tax-free. This one goes in pre-tax, grows tax-free, and then you pull it out tax-free. For next year, the 2022 HSA contribution limits, if you have a high deductible health plan, you should have the availability of a HSA account. Individual, if you're covered just yourself, it's $3,650. If you have family coverage, you can put up to $7,300. And if you're over 55 and older, you can put an extra $1,000 as a catch-up. So as that goes on, if you're young and you have the ability to pay for your medical expenses out of pocket up to your high deductible, you can let this, put this money in and let it grow for many, many years. And the next chart talks about tax-free portfolio growth. And this is an example of an amount a 35-year-old couple could potentially save over time by putting $2,820 each year in a health savings account. So this is a 30-year time horizon with a 7% return on investment with no withdrawals, and contributions are compounded annually. It's a very simple chart, but it basically, you start out with $2,820 at age 35. And as time goes on, you just put that little bit about, it grows in 30 years to $287,846, which that would be available for all of your future medical expenses. But there is a strategy called SHOEBOXing, as I mentioned, that you can actually keep all of the receipts or scan them. You don't have to, keep them. You have to have proper documentation of all of your medical bills or all of the things you paid out of pocket and have not been reimbursed for. And then you can submit all of those receipts and give yourself a large tax-free reimbursement later on. So it's called the HSA SHOEBOX rule requirements. And here's the 4 of them. As the expense was incurred after the HSA was established. So if you're 35 and you establish it, then it just has to, medical expense occurs after that. The individual keeps records sufficient to later show that the distributions were exclusively to pay or reimburse for qualified medical expenses. Again, that's keeping your receipts. Used to be in a shoebox. Now I'm sure we just scan them, save them digitally. The next one is the qualified medical expense have not been previously paid or reimbursed from another source. And that ties into the last one, which the medical expense has not been taken as an itemized deduction on any prior taxable year. So with those last two, it just means that if you pay for it out of pocket, you can't submit it for reimbursement to your insurance company. You can't be submitted to any sort of other employment plan for reimbursement. And then, of course, if you take it as a deduction on your Schedule A, your itemized deduction, that's considered being reimbursed or partially reimbursed. So you can't do that as well. And then you can, like I said, if you keep all your receipts and it grows from that small balance up to 200,000 and you have $200,000 in receipts, Medicare costs, any of those things, you can submit all of that at once. There's no time limit, and you can reimburse yourself a very large chunk of money at retirement, tax-free. And we've helped some of our clients set them up or invest them through our, like the program we talked about a couple weeks ago, FEX. So if you have any questions at all about your HSA account or how you can benefit from it, please reach out to your PWA or the Camarda main line, and we'll be happy to help you. That's all for today. Thank you so much. Again, my name is Troy Lerche. You can reach me at troy.lerche@camarda.com. Hope you have a great week and talk to you soon.